Yeah, I thought what you were saying there was that silver was going to make a run and then everything went dark.
Oh, it froze for like a minute.
Well, let's start
I'm
over.
I
So 2022 ended up being a pretty quiet year for gold and silver. We are in the midst of a bit of a rally based on the Fed finally conceding a little bit of that aggressive policy, but we need to see more than that for metals to really take off. So in this one, I'm going to be talking with Lior Gantz from Wealth Research Group. Now, he just has a lot more expertise than I do. Now, we're going to be talking about a few things. First, we're going to talk about Jerome Powell's most recent comments and the Fed's current stance on inflation, what that means for rates, the US dollar, and gold. Now, the spoiler here is that metals prices, well, he thinks they're going to go higher, but Lior explains when and how much. He's saying 2023 events will be good for metals, but then he gives the big catalyst. And that's not a for sure thing, but he thinks it's going to happen. That would be more than good for gold and silver. And that's more about jobs. And then one of the most interesting takeaways here is really Lior's thoughts on silver. Now, I don't know where I stand on that personally yet, but Lior thinks that silver has really big potential mid 2023. So make sure you hang around for that. I'm not going to give you any more intro. We'll just jump right in. So I think we start with Jerome Powell. He's been talking about softer rate hikes. He's also talking about them maybe sticking around longer. I think last time we talked, we were thinking maybe a 4.5% range for federal funds rate. Now it's probably looking like 5% and higher. So tell us what you think that's going to do to the economy, to the markets, and to gold.
yesterday Powell spoke at the Brookings Institute, and it was first of all a nice speech, a little longer than a statement. So that had some good jams in it. But then the Q&A, because the person asking the questions is not a journalist, but he's like a more high level. The questions were high level. I think Powell actually respected him. There's probably a relationship there. And then the questions from the audience were pretty sophisticated. We have some great things that we can talk about. So, for one, um, Powell talks about inflation in different three different areas of inflation that he wants to see get healthier. One has to do with goods. There he says we have V what do you call it? Like a check mark. So that's been check marked. The goods inflation, everything that has to do with freight, supply chains, etc., that is getting sorted out and looks really good. I've looked at a lot of data, congestion in ports. I've done hours and hours of this. The the inflation when it comes to goods, because you had a shock to the economy. People were staying at home. They were only ordering home goods. There was no service economy, so that was huge supply chain problems, etc. That has been taken care of for the most part. So don't worry about that. And the problem is that is what the Fed thought was the whole deal. They were like, it's supply chain, it's transitory. So that's been solved, and here we are. We'll still have incredible inflation. So no, it wasn't supply chains and it wasn't transitory. It became entrenched. So where is it entrenched? One is in the service economy for shelter. So these would be leases for rents and anything that has to do with the housing market. That is still very inflationary. And it doesn't look like the Fed is able to slow it down really fast. It may take another 2-3 years. So I think what Powell mentioned is we certainly don't have runaway inflation or hyperinflation or anything of that effect, but there's still work to be done on the services that have to do with the housing market. Now, he did say he doesn't want any human cost, any sacrifices, any victims to be had. So they rather start to ease on the amount of hikes they do, and perhaps even pause towards June. it would be the hint in his words, because they don't want to see a full-blown recession just to stop inflation. That they just don't think that's necessary, and that the economy can evolve into this new normal without the Fed going full pull Volcker. So that was really encouraging news. The third one is inflation in services that are not housing, and that's where labor costs and what we call entry-level service jobs. There's a lot of inflation there because there's just a shortage of workers. Because of the pandemic, a lot of boomers have just retired and they're not coming back to the employment cycle. So, and we have very low immigration rates, very low compared to pre-pandemic levels. So we have a lot of problems with too many retirees compared to people that want to work. That is another area where inflation is going to stay hotter. So the bottom line is that what the Fed is telling us is, hey, inflation is an issue. The world is learning to live in an inflationary environment. Unacceptable to us. Wink, wink. We're not going to crash the economy to get this solved. So for the next 2-3 years here, prepare for 4, 5, 6% CPI numbers, because that's the way we operate, unless a lot more people come back into the workforce and adjust this. And it's just not happening. So I think that's the big takeaway. And the other major takeaway is that the Fed is telling the market that it can live with that. It doesn't. This is not the same as in January of this year, when it looked like inflation was getting away from everyone and going to hyperinflation. So I think that's the big takeaway. And now we'll see how the market reacts to the CPI numbers that will come in early December, because they're going to do a 50 basis point rate hike. But more importantly is, let's see CPI, and let's continue to see the jobs market. That's the key. That is the key to the economy right now. Because if small and mid-sized businesses can't find employees, then we are headed to more of a wage spiral in the entry-level jobs, and that's just not the right way to grow this economy back in the 2020s.
Sure. So what you said there was something I guess I've been paying attention to. It sounds like in trying to avoid that full-blown recession, this pivot that everybody keeps talking about gets pushed off. And you just mentioned 2 to 3 years. Maybe those rates get held at that 5 or higher percent for a longer period of time. And that pivot, really that change from hawk to dove, that's really important to the change in gold price, because what that does is pushes the DXY down. It's basically headwinds on the dollar, tailwinds on gold. Do you see a big move for gold if this pivot, I've probably said it more than I should already, it's being overused, but if that gets pushed out, do we really see that big move for gold? Or do you think that that's a not like a sharp upturn, but maybe something that's just slower growth over time? How do you see that affecting gold?
First of all, we're seeing a breakout right now in gold and silver as we're during this interview, and that's because the market has priced 5.2 as the terminal rate for the Fed, and now it's that after the Brookings Institute Q&A session, that looks to be too much. So the Fed is probably going to gear towards between 4.6 and 4.8. So that's adjusting, and that is why gold and silver are rallying. Now, where they can really rally in 2023 is if two things happen. One, if we see a lot of layoffs, not in the entry-level jobs, but in the high-level jobs where stock compensation was the key driver for attracting talent. So take a simple comparison. Meta or Facebook pays a software engineer around 150K plus around 800,000 in stock compensation every year. AT&T pays around 160 base, but there's no stock compensation. So you can see how Silicon Valley was able to attract a lot of talent. But when a stock is down 60% or 70%, it cannot dilute and just buy back more shares when you have falling profitability and falling share prices. So we are going to see a lot of layoffs in the big tech and in the companies that that use the bull market to attract talent with stock compensation to the highest level talent. And I think that is why the market is pricing and is adjusting to a recession that doesn't include an insane amount of layoffs, because the entry level worker is not going to get laid off. It took too long to attract these people back to work. And the small mid-sized businesses, they rather negotiate hours and everything else, not lay off. High level, I think big tech has overhired, and they are going to start laying off. So that's why I think that the Fed is actually going to stop raising interest rates towards June and keep them there. That's when I expect a lot of risk on behavior to come back into the market. And that risk on behavior is what you're talking about. That is where the top is formed on the DXY. You don't need the Fed to start cutting. A cut would be almost a bad surprise. You need them to say, we're done. We're comfortable. That's it. We are in recovery mode. The economy looks to be recovering. Let's return to growth. And that risk on environment that I think will come towards the June 15 meeting, 2023, is where the dollar, in my opinion, creates that top. And that's when gold can start to really rally. And I think there's a chance that gold does hit over 2,100. In other words, a new all-time high in 2023. I can see that happening for sure, especially when you consider that with bonds this cheap and with stocks not that cheap, the need to hedge in our world, the need to add gold to one's portfolio as an institution is much greater than in the disinflation decade of 2011 till 2020. And I think that is the key driver that will lead to all-time highs for gold next year. So it's not 2-3 years away to me at all. Inflation is going to stay high, but because the two other important, or the three other important asset classes are in kind of a nowhere's land. They're not cheap and they're not expensive. Bonds, stocks, and real estate. The need to hedge all these big three with gold is much greater than at any other time in the past 11 to 12 years. So I really like that. And actually, if you really ask me, I think that silver has a much bigger chance of doing some incredible moves after the likely June pause than gold does. So silver can really explode up.
And you're saying that's because silver is more correlated to the DXY?
More inversely correlated to the DXY, correct. If you check out, I don't know if you've seen our report at wealthresearchgroup.com/out and /fake. Those two reports, /fake is about the dollar being a fake haven in 2022 and why we'll stop being a fake haven in 2023. What I mean by that, people will stop parking money in the dollar, not just because of the risk on environment, but because of China and Europe and a lot of technical reasons that made the dollar the go-to asset in 2022. And then the /out is about a fake out in terms of CPI numbers. We don't think the CPI is diving down towards the twos. We think it will take a lot of time to solve this wage problem for inflation. That's why we see it at 4 or 5 or 6% for 2, 3, 4 more years. And that is a big, big, big number in the U.S. economy. If you lose 15 or 16% in real terms on your purchasing power, I mean, institutions do not own the dollar. They're not over weighted in cash in that kind of scenario. They would rather have some gold exposure, and that's really important.
Sure. Let me ask you one more question. Lately, with basically anytime Jerome Powell comes out and speaks, we see the market rally and gold spike at the same time. We're seeing that right now. And a lot of that is based on these softer rate hikes or news rumors of these softer rate hikes. I wonder, do you see that stopping then in 2023, like you're talking about it being more about the jobs market and layoffs? Do we see a case where gold spikes while the market does not?
Yeah, there will be a decoupling. Right now, it's the dollar or all the other asset classes. So if Jerome Powell speaks and talks about, hey, there's a chance here of a soft landing, hey, we don't have to go into a recession, all of that is sell dollar, buy assets. So that's why you see gold moving with the Nasdaq and such. Now, in 2023, you get to a situation where, okay, so I understand mild recession, high inflation, and no growth. So we're in a stagflation. So in a stagflation environment, there is not a lot of reason to hug an index. You would not hug the Nasdaq in a stagflationary environment, or the S&P 500, or the Dow. You would look for ways to hedge anything that you're doing, and that includes a lot of gold compared to a normal period where hedging would not be as important. In 2022, people don't even hedge. They either short or are in cash. But that's because they were afraid of this hard landing and severe recession. If that likelihood is getting diminished and we're starting to get back into some sort of just a zero growth area, then I see that decoupling. And I think that the Nasdaq can stay flat here for another year or so, because there's so much more that needs to happen for the large cap tech stocks before they clean out the excess employees. I mean, just think of Google. Google doubled their employee count between 2020 and 2022.
Everyone was thinking that there's a paradigm shift. Work was changing entirely. All the shopping from home, and at Google, they're an advertising company. So
yeah, what this reminds me? It reminds me of the World Cup in Qatar, a country that had one stadium, and a few hotels, and then they win the bid for the World Cup. So they have to build everything, hotel rooms and stadiums and everything, and then the World Cup leaves, and what do they do with all that? And that's how the big tech had to deal with the pandemic. Everyone was home. Google needed so many more employees. Amazon needed them. Everyone needed them. But now, I mean, you don't need them. I think that is something that will take time to sort out. And as this happens, the Nasdaq just doesn't have what it needs to explode. And in the meantime, Europe looks a little better. Especially, it will look a lot better after winter. And China looks to be peaking in terms of their playing COVID over there. So that's important, because if they're done playing around and are going to reopen, that obviously is really important for the dollar. Yeah, the dollar trade peaking, because if the world's second largest economy is working again, that helps Europe, that helps everyone, and you don't need to be in cash. You don't need to be as afraid as you are right now. And Wall Street is definitely afraid. The sentiment is worse than in 2008.
Okay, let's try to give the big picture overview here to wrap this whole thing up.
I really think that between December, so where we are right now, and June, this will be where the rubber meets the road. You will see exactly what type of recession we're getting into. Is this, wow, there's bankruptcies everywhere, no funding for startups, like crazy type of 2008 mentality? Or is this, okay, some people are getting laid off, some departments are closing, some real estate is distressed, but overall, soft landing?
Yeah, there it is. I was counting down for for you to use soft landing.
I mean, everyone uses it. In a hard landing, you would have double-digit recession. I'm sorry, double-digit unemployment, and you will have problems that hit uh, Main Street and make this a political event. Right now, it's not a political event. Right now, it's a reset of valuations. So politicians are not getting involved because billionaires and millionaires are losing 2 years worth of equity appreciation. But if the average person is calling his congressman and telling, hey, there's no jobs, I've tried everywhere, and then you have a real hard landing recession. And my opinion, it's not going to happen, but we shall see. In the next 6 months, we will know everything.
Yeah, and it does feel like that's kind of the Fed's approach to no sudden movement. So that soft landing does make sense. That's kind of why I was waiting for that. It feels like that's what their overall goal is, just kind of bring it down softly.
Absolutely.
All right, Lior, I feel like that's a good wrap. So thanks again for spending the time. I appreciate it.
Always a
I'll
pleasure.
get those reports linked as you mentioned them, and then I'll make sure that your website is linked at the end.